Okay, in this video, I'm going to be talking about cap rate. What is cap rate and how do we calculate cap rate? So the formula for cap rate is the NOI divided by the sales price. It's the net operating income divided by the sales price. So why is this relevant? Essentially, think about a cap rate as the return on investment if a property was paid for in all cash, right? So because if a property is paid for in all cash, the NOI is equal to the total income of that property. So the cap rate is really a way to evaluate each property independently, separate from the mortgage. So if you want to look at a property independently and know what is the return on this property separate from the mortgage, so with the asset alone, cap rate is the best way to do this. And when we look at cap rate, we'll notice that the higher cap rate properties are typically in worse parts of town, and the lower cap rate properties are typically in better parts of town. This is because if a property has an extremely high rate of return, it's probably because this property is in a higher risk area. It's probably because this is in an area with higher crime, and probably if the cap rate is too high, it's not an area that we want to move forward with. Whereas if we were to invest in a property on the coast, New York, California, Washington, you can find cap rates as low as 4%, sometimes even 3%. So the rate of return on these assets is very, very low, but the risk is also very, very low. Another thing to note with cap rates is that cap rates follow interest rates. So cap rates are ever changing. So as interest rates increase, so do cap rates. As interest rates decrease, so do cap rates. So if you're purchasing an asset, particularly with multifamily, if you're purchasing a multifamily asset, you're going to determine the end value of this asset by taking the NOI divided by the cap rate. So if you are in an interest rate environment where today, let's say rates are 7%, if you run your cap rate at a 6% cap rate, it might be a good idea to run your end cap rate at the refinance 2 years from now at a higher cap rate just in case interest rates increase. The reason why a lot of people got in trouble during the COVID era is because interest rates went from 4% interest rates to double that, 8% interest rates. But a lot of people underwrote their real estate at the same cap rate of those 4% interest rates. They didn't stress test the deal in case interest rates increased. And as a result of that, a lot of people got into trouble. So that's how you determine cap rate. You take the NOI divided by the sales price. So make sure that you're paying attention to this cap rate as a risk metric. If you're purchasing a property in a high crime area and the cap rate is very low, you probably have an issue. If you're purchasing a property in a low crime area and the cap rate is high, you probably also have an issue. So use this when moving forward with all of your investment properties.